Federal Reserve surprising inflation forecast. What it means for stocks.
The Federal Reserve is all but assured to raise interest rates by another quarter percentage point this week, with Fed Chair Jay Powell likely to keep the door open for further interest rate hikes later this year. Fed fund futures pricing in a nearly 100% chance of the Fed raising rates by 25 basis points on Wednesday. A 25 basis point rate hike would mark the central bank's 11th rate hike in nearly a year and a half. It would take its benchmark interest rate, that Fed funds rate, to a range of 5.25% to 5.5%, a 22-year high. With no new interest rate projections or economic forecasts released this meeting, all eyes will be on Fed Chair Powell and the outlook for monetary policy. Powell is likely to talk tough on inflation and suggest another rate hike in September could be possible to avoid financial conditions loosening. EY chief economist Gregory Dacko says given the strong job market and elevated inflation still, he would expect Powell to talk hawkish during that press conference, saying, quote, "The last thing policymakers want is for markets to start pricing the Fed's terminal rate and rapid rate cuts in 2024, which would lead to looser financial conditions and upside risks to demand and inflation." Now, last meeting, officials penciled in 2 more rate hikes for the second half of this year.
Wow, you won't believe what the Federal Reserve just announced regarding inflation forecast and their implication for the economy. This is a crucial topic with a lot to unpack. So let's dive in. The Chicago Fed just released a significant report discussing the past and future impacts of recent monetary policy tightening. While I'd love to dissect all the economic jargon in there, let's focus on the abstract and conclusion. According to the report, the majority of the effect of high interest rates on output and inflation, essentially the lag effect of the Fed tightening policy, have already about 70% to be precise. What's interesting here is that the tightening policy that has been implemented is expected to continue exerting restraint on the economy, leading to 3% point downward pressure on GDP and 2.5 percentage point decrease in CPI. However, the effect on the labor market are predicted to manifest more slowly, with more than half of the impact on total hour work yet to come. Now, why does this matter? Well, some experts believe that pain in the job market could be the catalyst for a recession. Typically, recession can start due to various factors such as cyclical or industry-related issues. In this case, it could be due to job market pain leading to decreased spending, lower company earnings, layoffs, and a vicious cycle of economic decline. However, the Chicago Fed suggests that the majority of the tightenin's impact on GDP and CPI has already occurred, with only about 15% of the pain of the labor market remaining. According to their models, the tightening implemented so far is enough to bring inflation back near the Fed's target by mid-2024 without causing a recession. But remember, these are just models and forecasts. Now, let's talk about the importance of managing expectations. The Fed has been quite clear about its intention, emphasizing that there may be more rate hikes in the future. Why? Because as soon as they signal that they're done, it encourages people to lock in the high yields on long-term bonds, like 10 years or 20 years. This increased demand drives yield down, effectively losing financial condition. But here's the tricky part. The Fed wants to put pressure on the market by keeping those long-term yield higher. So they have to be cautious about signaling they're done too early. This will then impact the yield. This will then impact the yield curve and the broader economy. Now, concerning inflation, the Chicago Fed's model suggests that inflation will likely fall below 2.3% in 2024, which is historically translated to around 2% in PCA terms. This suggests that the Fed's target could be met by mid-2024 without a recession, even though there are still uncertainty bands around this forecast. And what about the yield curve? It's cruel. Recession? No, but it might not be that simple. Expectations play a significant role in setting the yield curve. If people expect yield to go up the next 2 years, they may not want to invest in shorter-term bonds. Instead, they may option for money markets until they can lock in those juicy long-term bonds when rates eventually fall again. This shift in expectation can distort the yield curve even if a recession isn't guaranteed. Remember, the yield curve isn't always right, but it's a valuable indicator. Now, let's talk about companies. Some sectors will benefit from falling rates, like cyclical interest rate sensitive ones, such as Tesla and Empire. On the flip side, stocks like Dollar General, Hershey's, and Walgreens may suffer. McDonald's in particular could face headwinds as restaurant spending has started to flatten and the cost of food and waste remaining high. Now, how about my opinion? McDonald's is overvalued. I'm serious. And the stock price needs to come down. Lastly, let's address Starbucks. It's an interesting case as it has been holding up well despite its premium valuation. I've been waiting for a dip into the $18 to consider investing because Starbucks quickly expanded in presence in China during the pandemic. Unfortunately, China's current situation isn't ideal. So there you have it, a deep dive into the last insight from the Chicago Fed and their potential implications. Thanks for watching. Stay informed, stay curious, and stay tuned for more updates. Bye.